Hey guys, in today's video, I want to go over what a REIT is. So REIT is short for Real Estate Investment Trust, and this is an important investment for many people because owning a property isn't the only way to invest in real estate. One popular method is to invest in a REIT. So a REIT, short for a Real Estate Investment Trust, is a trust that allows individuals like us to invest in real estate without having to physically own it. So a REIT is a company that owns and finances income producing real estate. When you invest in a REIT, you're essentially buying a share of that company's real estate portfolio. Investing in a REIT is similar to investing in stocks. You can buy and sell shares of a REIT on an exchange, and the price of the shares can fluctuate based on the market conditions. One of the benefits of holding a REIT is that you can gain exposure to a diverse range of real estate assets without having to buy and manage individual properties yourself. So this is why I really like REITs. You can own a variety of properties such as office buildings, shopping centers, hotels, and even apartment complexes. Another benefit of holding a REIT is that they are required by law to distribute at least 90% of their taxable income to the shareholders in the form of dividends. This means that investing in a REIT can be a good way to generate passive income. However, like any investment, there are risks involved. The shares can go up or down based on market conditions, and the performance of the underlying real estate assets can also impact the value of the shares. Also, different types of REITs have many different risks and potential rewards. For example, some REITs that focus on a specific type of real estate, such as healthcare facilities or industrial properties. If you're interested in investing in REITs, it's important to do your research and consider factors such as the REIT's track record, management team, and the dividend history. Investing in a REIT is a great way to gain exposure to the real estate market and generate passive income in the form of dividends. Its cost to entry is a lot lower than holding physical property, as you do not require a large down payment. You can get started in REITs with as little as $20. Just be sure to inform yourself and to approach it carefully. And yeah, with that guys, in today's video, I'm going to be going over my favorite REITs in Canada to invest in for dividend income. Alright, so we'll get started with VRE and XRE. So these are the two biggest REITs in Canada. VRE coming from Vanguard and XRE coming from BlackRock. So these are the biggest REITs in Canada, and they pay about, this one is 4.2%. BlackRock right now I believe is around 3.6, 3.77. So the yield isn't as high as you would see in other covered call ETFs, but that's because they don't do covered call writing. This is mainly the REIT index ETF. So if you're looking for some more growth as well, as long as picking up some dividends along the way, these ones are for you. And yeah, so these ones funds highlights seeks to track the performance of the best Canadian all-cap real estate 25% index to the extent possible before fees and expense. Employs a passively managed, full replicated index strategy to provide exposure of Canadian large, mid, and even small cap companies in the real estate industry. Uses efficient, cost-effective index management techniques. So yeah, this one's inception, it's been around for well over 10 years now, November 2nd, 2012. And we'll go over to the holdings. We'll see some very similar holdings in the Canadian side. We'll see Canadian Apartment Properties REIT making up the most. You got First Service Corp, RioCan. RioCan is also a very popular one in Canada. Granite REIT, Summit REIT, Choice Properties, and many more. Overall, we are greatly diversified, and we got great sectors as well. So we got retail making up 22%, industrial 17.7%, real estate services 16.7%, residential 14.9%, office REITs 12.2%, and yet many other great sectors to be investing into. And yeah, we'll go over to XRE. XRE is the BlackRock Capped REIT Index ETF. So this one is also very similar to Vanguard, as we see exposure to Canadian real estate income trust, exposure to different types of REITs, and you receive monthly distributions. Both Vanguard and BlackRock are monthly distributions. All right, and the average is 9% over return year over year. So some years it's a lot more, some years it's a lot less, but average is out at 9%. And yeah, this one is a great one as well. I really like the design of this BlackRock, how they designed their website. Very nice to appealing to the eyes. And yeah, distribution monthly, distribution 3.77%. So it is a little bit lower than Vanguard. Yeah, and we'll see some great stuff here. Risk medium, management fees. And yeah, so if you go down to the holdings, they are very similar to Vanguard. We see Canadian Apartment Properties making up number one as well, 14.6%, 06%. RioCan, another favorite here on Canada side. Granite REIT, Summit, Choice Properties, First Capital, and yeah, more great REITs. And yeah, we'll go over to the sectors. So we saw sector 22.9% in retails, making up the top. This one's a little bit more on the retail side at 37.12. Then we got residentials at 24.6, industrials making up 21.7, and yeah, diversified REITs 7, office REITs 6, healthcare 3.38. So yeah, we are very diversified in this one as well. We're also getting more retail exposure. So if that's what you're looking for, more retail, maybe this REIT will be slightly better than Vanguard's. And yeah, overall, these are both two very good ETFs in Canada to invest in for dividend income. They're the largest by market cap on the Canadian side. As you see, BlackRock's net assets, this is 1.14 billion. That's a lot. And yeah, with Vanguard's, we'll see total net assets 324 million. So BlackRock's is larger, but yeah, both overall, they're both great ETFs to invest in for passive income. And with that, guys, this is my favorite REIT for dividend income. It is Real Estate Split Corp, and it is from Middlefield. So Middlefield is also a great provider. It's a very clean, nice website, and they have some reputable managers managing this REIT. And we see, so this has a target yield at about 8%. At the time of recording, it is at about 10%. So 10% yield right now, that's great. So exposure to underlying performance of a high conviction portfolio of real estate issuers on a unique split share structure. So this is a split share. So we got Class A shares and preferred shares. So I like the Class A shares because they have the higher yield. It is slightly more risky. So if you want the less risk, you can go for the preferred shares. The Class A hit share does have more yield. So the Class A is 10%, and then the preferred shares are lower. So inception date November 19th, 2020. So this is really it's newer than the others that we looked at, VRE and XRE. This one is November 19, 2020. So this was positioned near the pandemic crash, and it has a nice recovery since. Management fee is 0.85%. That's pretty standard for companies that we get. This requires more work for the fund managers. As we see, fund managers, Dean Orico, Robert Moffat, these guys do a great job managing this REIT. So Class A shares since inception averaged 12.5%. That is amazing, guys. So we are really getting some great exposure to real estate in this one. Great captures, great job by these fund managers. And also with Class A shares, this is a split corp, meaning that it is slightly more risky, but they have never missed a dividend. They have been going 13 cents and haven't stopped. Sorry, 13 cents right now, and then they haven't stopped. They have never cut, and they have never missed dividend payment. And yet, so we go down to the sector allocation. We're getting retail REITs at 37.4%, industrial at 27.8%, residential at 19%, diversified REITs at 6.8%, office REITs at 3.3%, healthcare at 3.1%, and specialized REIT at 2.6%. So we are greatly diversified in terms of sector. Top 10 holdings. This one is slightly different than the others. We got Dream REIT at 8.1, making up the largest position. We got Summit at 7.9, Granite REIT at 7.8, H&R at 6.8, Choice Properties 6.4, RioCan 6.3, Gramble REIT 6.2, and yeah, all these other great REITs. And we see the geographic allocation. So primarily Canada focused, and then we do get a little bit of US as well. And yeah, with that, guys, this is my favorite one. And we go down to the fact sheets. This is taken from December 31st, 2022. So growth of 10K. As we see, they really took advantage of that, the dump, the crash. And we see, because they did start near the end of 2020. So they positioned themselves perfectly. So these guys did a great job. They started here, and they really wanted to take advantage of the recovery, which is what they did. They saw some great recovery. As you see, we did go down a bit more, but overall, this is a great holding regardless. And yeah, as we see that Class A shares at this time, towards the end of 2022, it was at 12.4%. So it was even higher than we were sitting at right now. And yeah, we see sub-industry allocation. This is greatly diversified. So yeah, if you want Canadian REITs, this is my favorite. It's a lot more yield than the others, so you are getting a lot more income with this one. You may be sacrificing a little bit of upside potential, but if you're looking for dividend income investing, this is my favorite one. And yeah, with that, guys, Make sure to like, subscribe, and comment any other videos you would like to see. I like to read my comments. And yeah, with that, guys, take care.